Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss the rise in financial literacy among young adults, adjustable rate mortgages, eligible designated beneficiaries, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Oh, things are good. Things are good. You know, kind of the end of golf season, all the charity tournaments. So I'm getting ready to head out to to support and volunteer at one that helps different youth charities and things. So should be a lot of fun, and hopefully we raise some money for some good causes.
Yes, sir. Absolutely. It's nice to get into a place where you can do a lot of giving back and have fun in the process.
Well, that's usually the fundraisers that work, right? That it's fun and it's bringing in the money, so you get the win-win.
Absolutely. Well, let's dive right into the rise in financial literacy among young adults. This was really exciting to open up the Personal Financial Review and read this section. And there's so much that I was unaware of. Of course, as you know, my oldest, very switched on, wants to be very financial literate, which has helped me immensely too, to learn in the process. So this is just wonderful to see that there is a rise in it. I mean, there's several factors: educational initiatives, technological advances, and really a growing awareness about finances in general.
Yeah, absolutely. Yeah, I think your son is a great example of what we're seeing. I mean, this information, when we dug into it, was kind of, trying to parse out some of the different media articles that you see, and one of the things that's kind of frustrating is, you see these headlines, and then, you'll see one that contradicts it, and you wonder what's really going on here, right? Mm-hmm. I mean, you hear about, millennials or Gen Z are, so much worse off than their parents, and, they're all the issues that they're having with finances and student loan debt and things. And then you see an article that talks about, how millennials and especially Gen Z, who's even younger than they are, is actually, one of the most financially educated and competent groups in terms of what they're doing with their money and the decisions that they're making. And, this is a, important topic for a lot of our clients who have kids or grandkids and, are seeing these same headlines and kind of wondering, okay, what's going on? What are we really seeing out there in the market? And one of the surprising things, like you said, is, despite some of the economic challenges, student loan debt, housing affordability, those things that get a lot of press, that actually younger people we're finding have really access to more financial knowledge than people have in the past, and really been able to use that to navigate their financial futures pretty successfully, if you compare them to other generations when they were the same age or in the same phase of life.
Yeah, I think it plays a lot into, I think just more people of younger generations are wanting a greater overall wellness, and they realize how much, at least those that I have spoken to for sure, they're very switched on to how much your finances can have an impact upon that.
Yeah, absolutely. And that's one of those things where, you see a lot of research on different social issues, and often one of the things that comes back to is people's financial situation, right? And that, that has an impact on their level of education, overall health, obviously, career, even personal relationships, and of course, retirement, right? Their ability to retire or have a comfortable retirement. And so, that importance of financial literacy and helping people address those challenges, both on the day-to-day, but then as it, builds, and as we often talk about, all progress is incremental, little by little, it bleeds over into these other areas that, really is not just important when it comes to financial security, but people's overall well-being.
Absolutely. Well, what are we seeing on the educational front? I mean, I was unaware that there was any financial literacy education that was initiative that was happening, and I mean, in more than half of the states in the U.S. I mean, hey, that's good. That's more than half, but it's also slightly more than half.
Yeah, yeah, and it's something that's evolving. I think there's really kind of three main causes, right, of the shift that we're seeing. And the first one is that a lot of states have focused on financial literacy education. You know, as you said, 26 out of 50 states now require students to complete a financial literacy course in order to get their high school diploma. So even those that maybe aren't going on to college or going into a trade school or something like that, you know, get into them early to hopefully at least teach the basics so that they're prepared as they, you know, leave high school and transition into adulthood. And even California is the latest state to adopt that requirement. So it's something that, you know, is being phased in. It won't be fully implemented until the 2030, 2031 school year. But I think that that we're seeing that it's having a big impact in a lot of places, and actually some associations like that I'm involved in with the Financial Planning Association, it has been a big source of lobbying for these types of programs because we've seen the success it's had in other states. And so there's a concerted effort, members in different states actually going and lobbying the, you know, politicians at their state capital. We have these advocacy days where we'll go and we'll talk to politicians about, you know, the importance of financial planning. And we've really tried to put a real focus on especially the younger people, because we know that's where we can probably have the biggest impact in terms of, you know, people's overall financial wellness. And you know, obviously younger people are going to school. We have these institutions where we can target, whereas, you know, once we become adults and we kind of distribute throughout society, it's a lot harder to, you know, get access to a broad range of people in order to be able to deliver that message and the education and the skills that they need.
Yeah, and I'm you know, I mean, you know, the work that I do and to share with the listener viewer that a lot of it surrounds mental health separate of what we do here on this podcast. I guess my when I'm wearing my cape, so to speak, and in seeing that, and that is such a big thing that is mentioned for a lot of the young folks that we work with is they worry so much about like there's nothing for me. And you know, for folks such as yourself and these associations and to really get this out there, it's huge because they can actually start to see and have the skill sets to build something for them for a life to have. And it really gives a lot of hope, faith, and self-esteem. I mean, you know, those things that we can earn and build, that's priceless. So it's incredibly encouraging for sure.
Yeah, you know, and part of the real challenge is teaching people how and where to find the resources, right? There's a lot of things out there, but they don't know about it. So you're right. They're saying there's nothing out there for me. How do I figure this out? Well, they kind of have a blindfold on. They're not, you know, they're not seeing everything that's out there. And I think that's where, you know, even just an introductory financial education course can really help because it then, you know, shows them the path that they can take to become more successful. And we're seeing a good shift there in terms of, you know, the level. I mean, 30% of Generation Z have taken a personal finance course. So that's better than 20% of millennials. You know, Gen X is only 17% and the baby boomers were just 7%. So, you know, as you pointed out, you know, only half the states, we still got a long ways to go. That means, you know, 70% of Gen Z were not exposed to, you know, this type of knowledge and education, but hopefully we can keep moving the ball down the field and getting closer to that end goal where it's more just a ubiquitous part of the normal education system.
Absolutely. Well, what are we seeing as far as you know, digital platforms, apps, and things along that line?
Yeah, I think that's the second you know, big change, right? That's where we've seen this shift. I mean, we're so fortunate, right? That you don't need to go to a library. You don't need to go seek out information somewhere. I mean, you've got the supercomputer in your pocket and the access to so much information. And so young adults are finding it's an easy, you know, place to access information through podcasts, right? But also through social media, and then different influencers and things that really focus on financial education. So I think, having that front of mind and having it just at your fingertips has really helped. Of course, as we've talked about in the past, it also means you got to be a little bit careful, right? There's a lot of influencers out there that share financial advice that, they're not financial professionals. You do need to take individual responsibility in making sure that any tax or financial advice that you're getting is accurate and not just something, somebody's using to drive engagement and maybe exaggerating or pushing the limits of what's really allowed to try and bump up the number of users and monetize what they're trying to do.
Yeah. Well, and I'm glad you included this in here too. Of course, parents can play a huge, significant role, and it's definitely been the case as we mentioned my son, and you've been a mentor to him, and these are such important things of how we as parents too can really guide our children, help them start to make responsible choices, and understand, if let's say they get $500 for their birthday, how much of it, or hey, set some aside for fun, but let's get the other in a savings account, or look at investment vehicles and, these things. Let's turn that money into something more than what you just have in your hand at the moment.
Right. And just having those conversations, right? Being open. I know in some of your other podcasts on mental health and addiction recovery, you talk about one of the problems is people just don't talk about these things, right? There's kind of a stigma. We don't talk about it. And so it keeps people from really getting the help that they need. And there's been a lot of that about finance too. It's been a topic where it's kind of a private matter. People don't want to necessarily share, how much they make or where they're spending their money or how they're managing their money or how they're investing or, all of those things with other people, including family members. And I think a lot of times, kids are growing up in a household, which, if you think about it, a household is really kind of the base economic unit of our country. And yet they're not really seeing that aspect, right? The finances, you pay the bills, you do these things that's kind of behind closed doors, and they're not participating. And so, something parents can do that's just as a huge benefit is to have those conversations, include kids on, okay, this is where the money comes in. This is the taxes that are taken out. This is how we pay bills. This is, how we manage, debt such as, car loans or mortgages or things like that. And, just that early exposure and starting to think about how these things work, one can be just really helpful when it comes time for young people to be making these decisions on their own. And also, it may spark some interest where they'll want to go and learn more and dig a little deeper and understand how these things work.
Yeah. Well, and you wrap up here with something that's very important, and I still don't have the greatest grasp, so I might have to get a call on this. Is what you state, one of the most important concepts to teach is the power of compound interest.
Absolutely, yeah. The power of growth over time and earning money on money that you've earned, right? Einstein said that was the most powerful force in the universe was the power of compound interest, and I think it's something that people miss. When you're in debt, you're kind of on the opposite end of that. You have one of the most powerful forces working against you because you're not just having to pay back the principal, but you're paying back interest, and so it's taking a bigger and bigger chunk of your financial resources. Whereas if you're running a surplus and you're setting it aside, even if you've got it in a high yield bank account, or maybe better yet, have some money invested so you can get a little bit higher growth rate. It doesn't seem like a lot at the beginning because usually it's not a lot of money, and even a decent percentage return on a small amount of money doesn't look so hot. But you run that out over 10, 20, 30 years and it can really add up.
Absolutely. Well, anything else you want to add before we move to our next topic?
Well, just, if clients or people listening are interested in, some different financial resources, or, maybe want to know, okay, how can I talk to a younger person, a son or daughter, a grandson or granddaughter, feel free to reach out. This is an area that we're very passionate about because, we can see the value of young people that we've worked with, clients, kids, where we've coached them through, and it's amazing how successful they can be so quickly versus going through a kind of a rough decade as they get their footing and then finally start getting serious about money. it's amazing how they could end up sacrificing very little and end up with a really strong financial foundation. Just through some conversations and some resources and just that it's a topic that's top of mind for them.
Absolutely. All right, let's jump into adjustable rate mortgages. Adjustable rate mortgages, AMRs, is what we refer to it here. They're loans that start with a fixed rate for an initial period of time, but adjust after the initial period expires. And I think there's a lot of confusion about AMR loans that you bring a lot of clarification to here.
Yeah, and historically it was something that I think a lot of people kind of pushed to avoid, right? We like the fixed rate. We know what the interest rate's going to be. We know what the payment's going to be. It's kind of more comforting and stable. Whereas a lot of people would avoid those adjustable rate mortgages because, they're worried about, okay, now, what are interest rates going to do and what's that going to mean for my payment down the road? And that uncertainty is a concern. And I think in the past, maybe that was a good thing, right? I mean, we went through a very long period of very low interest rates. And so locking in that low fixed rate was pretty attractive. And for a lot of people was probably the right move. But now we're in a period of much higher interest rates and a lot of, expectation that interest rates may be trending down in the future. And so in that type of environment, if you can take an adjustable rate mortgage and start out with a lower initial rate compared to a fixed rate mortgage, and then potentially even have the possibility that it adjusts downward in the future, then it can have kind of a double benefit there, right? You're starting lower, and you could even see it go lower down the road versus locking in a fixed rate today, then potentially having to take on the cost of refinancing, that type of thing. So we are in an interesting market where don't want to say that one or the other is right in every situation. It's all individual, but people may want to actually explore their options and kind of weigh the pros and cons.
Do you think that after, what was it, 2008, when we had the housing situation and some of those loans, that adjustable rate mortgages kind of got a bad rap, or that those loans were kind of lumped in with an adjustable rate mortgage, so to speak?
Yeah. I mean, that was part of it, right? There was a lot of things where you had mortgages that adjusted, you had mortgages with balloon payments, you had mortgages that were for 40 years instead of 30 years, so you weren't really paying down much principal. There was a lot of different things that happened. But yeah, I think adjustable rate mortgages got tied in with that. And then, following the financial crisis, interest rates were very low. So they probably didn't make sense after that either. Whereas, most people that were looking to refinance or to buy, it made sense to lock in those very low interest rates. But now it may be different. And, especially when you understand that, the average person keeps a loan for about 7 years. Right. And then they either move and sell and start over with the new mortgage on the new property, or they refinance because, something has changed and either they need to cash out some equity or they're refinancing because interest rates have gone down and they can get a better deal. Whereas an adjustable rate mortgage, can kind of help in those situations. I mean, if you're looking at only 7 years before maybe the next move, maybe starting at that lower interest rate, even if rates tick up a little bit, you might find that your average over that 7-year time period is similar to what you would have gotten on a fixed rate mortgage anyway. And if interest rates go down, then you come out ahead, and you're not really planning on a 30-year fixed where you're trying to lock it in for a really long time period. Or, if interest rates go down, if you're an adjustable rate, then you see it go down. You don't have to go and refinance and, pay those loan origination fees and everything else that may come with that to take your fixed rate back down to a lower fixed. But you always have the option to do that too with an adjustable rate. So, if interest rates get really low, yeah, you might have this really low rate, but you might say, well, okay, it's time to now switch and really lock in this low rate. Just in case, if you plan on staying in the property for a long time period, it protects you from the potential of rates going back up. So you kind of get the best of both worlds.
Sure. And with adjustable rate mortgages, is there kind of a threshold at both ends of how low that the interest rates can get and how high, or is it really depending upon what interest rates are in the current climate?
Yeah, with adjustable rate mortgages, and that's why I say it's kind of an individual thing because you really want to understand they do have different stipulations. So, a lot of them will have a certain annual reset, right? So the date usually of when the loan was originated, 1 year later, potentially a reset, or sometimes you'll have them where they're locked in for 3 years and then they adjust, right? So it can depend on how long you're going to have that stable rate before you have to worry about the adjustment.
Mm.
And then a lot of them do have limits that, they can only adjust so much in a given year. So if we went through a really weird period and interest rates really shot through the roof, it's a limit on how much your mortgage can adjust upward in a given year. Although you could have several years in a row where it continues to adjust up by that maximum threshold. And then, yes, as you said, a lot of them do have a floor and a ceiling, right? So that also offers some protection that, it can only deviate so much from that initial rate, regardless of how much interest rates fall or how much they go up. So you can kind of gauge what would be your best case and worst case scenario, and then look at it and say, okay, can I bear this risk, right? Do I have sufficient cash flow, et cetera, that if we went through a weird period and interest rates went up a whole bunch and you had, 3 years or 5 years in a row where your mortgage rate continued to adjust upward, then, will you be able to meet that mortgage obligation, and therefore you're able to bear that risk to then potentially get the benefit should it move in your favor.
Thank you for the clarification. Anything else you'd like to add before we move to the next section?
Well, I've already said it twice, but just really want to stress, this is an individual decision. Each person's situation is different. I think it's really important to, one, understand all of the terms of the loan, and two, probably makes sense to meet with a financial professional and kind of walk through what that means and what are some different scenarios to make sure you're comfortable, because, mortgage, that's typically a big decision in people's lives, right? Buying a house and taking on this big mortgage. And so it's going to have a big impact on people's long-term financial success.
Absolutely. All right. Eligible designated beneficiaries. We've talked about beneficiaries when it comes to different retirement plans and so on, but here we're talking non-spouse beneficiaries of IRAs, and really more clarification on the rules, because it seems there's always something coming through, a change up of sorts.
There's always some little twist, right? And this is something we've come across a couple times recently that I think has kind of been lost in all of the changes in the law. As we've talked about, if someone passes away and their spouse is a beneficiary of a retirement account, their spouse can basically take it over and make it their own, right? They get special rules in that respect. If it's a non-spouse beneficiary, generally what you see is that the old stretch IRA rules, where they could stretch the distributions out over their lifetime, are gone. Instead, they have to take required minimum distributions each year, but they have to have completely distributed the account within 10 years, right? So that's become more kind of the norm, or what you see most often. But there is another rule, right? There's an exception to that rule, as always seems to be the case. If you have a non-spouse beneficiary that is not more than 10 years younger than the original owner, right? So, when does this happen? Well, a lot of times you see it where, maybe someone doesn't have any kids or heirs, or maybe they just don't want to leave the money to them and they leave it to a friend. Or in other cases, you see it might be a sibling, right? An older sibling, or maybe a younger sibling, but they're only 3 or 5 years younger. Well, then in that case, that money could be going to someone who's not 10 years younger than the original owner. And they actually get to work off of the old rules, where they don't have to fully distribute that account within 10 years. They can still stretch it out over their lifetime, which can be a really big benefit in terms of the flexibility around tax planning, and being able, to keep that account growing for a long time period, and make it more like a, monthly or annual retirement type payment, as opposed to something that needs to be distributed, pay the taxes, and then either reinvest it or do something else with it. So it's to kind of come full circle, we've talked about these changes in the rules that came from the Secure Act quite a bit, and we found that this exception, a lot of people just aren't aware of it, right? They think, okay, inheriting an IRA from a friend or a sibling, and we're about the same age, and now I have to distribute it within 10 years and pay all this taxes, and say, whoa, 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 actually, no, you're still in under the old rules. You have a lot more flexibility here.
Yeah. Well, and that's a good situation, as you always say, to contact your financial planner and explore all options.
Exactly, exactly. Because these things are so complex, right? I mean,
Yeah.
these new rules, they're constantly changing, and there's just so many different provisions that it's going to impact people very differently. So you could be talking to a friend or family member, and they say, "Oh yeah, I inherited account, and this was the rules, and this is what you have to do," but maybe not realizing that you're in a different situation than they were.
Yeah. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. Two items pinned up there. What do you got first, Mr. Armour?
Yeah, well, one, we've been doing a fair amount of continuing education as we always do, and a lot of it focused on preventing uh, different frauds or financial scams, right? And I mean, we want to be doing our part for sure. We also want to be educating our clients, and we want to make sure that we're being very vigilant if we see anything that doesn't look right, or that's a concern, that we can step in and hopefully avoid a big loss. And one of the things that was kind of very interesting to me is really the difference between a financial fraud and a financial scam.
Mm.
And a lot of times we kind of use those words to mean the same thing, but it can have a big difference on whether or not someone is able to recover assets or recover money that's lost. So a financial fraud, is basically when a bad actor accesses someone's finances illegally without the knowledge or any action by the victim, right? So this would be kind of your classic identity theft, right? They get a hold of your information, somehow they get into your bank account, or they steal your credit card number, and next thing there's some fraudulent charges, which actually happened to me recently. Well, in that case, you're generally not liable because you didn't do anything, and usually there's some law or policy or something that will step in, and you'll end up recovering any of those funds. Whereas a financial scam generally involves the perpetrator convincing the victim to take some action.
Mm.
So whether that's transferring funds, making a purchase, purchasing gift cards and mailing them somewhere, right? And so these scams are often, it's under false pretenses, right? Usually trying to trick the person into doing it. But a lot of people don't realize that typically, if you're the victim of a financial scam, then you often have very limited recourse in terms of being able to get the money back, right? Because it's a case where the financial system worked the way it was supposed to. It's just you took an action that you should not have done because you didn't realize what was going on. And I think that is a really important distinction for people out there, because financial fraud, there may not be a whole lot we can do because we're not really involved or participating or taking any action. But I think it's very important for people to really think twice before they take any action that could cause them to lose money to a financial scam, because they not only do they not have those protections, but there's that point, right, where they can actually protect themselves by being really careful and really scrutinizing it, and maybe just saying, I'm just going to wait and think about this, because a lot of these things, it is all about you need to act now, right? Call to action. They're trying to get people kind of more into an emotional state, and doing something that they will end up regretting. So if you're not 100% sure, just wait and say, okay, or talk to someone, right? I mean, obviously you can give our office a call if you're not sure, or talk to a trusted family member that knows about these things before taking any action, because often once that action is taken, it can be irrevocable, and those funds may be lost.
Yeah. Well, let's take a look at the second item. You were able to get on out and speak with some young individuals around our old stomping ground. You were at UC Santa Cruz, pretty close to our hometown.
Yeah, it was fun. There's an annual event that the Financial Planning Association puts on called the Far West Roundup. It's a pretty kind of laid back, casual type event, which is fun, and it's held on the UC Santa Cruz campus. And it's really targeting practitioners who are new to the financial planning industry. Although what I found was it was very interesting. It was a very diverse group. You had some people that, I'd more consider veterans of the industry. You definitely had some newer people. And then, you had some newer people that were career changers, right? So maybe, not necessarily young people, but, it's still kind of hitting the target of the conference. And it's really focused on, networking and kind of helping, people make that transition into the business. So they had some great presentations. I was able to catch a couple of them, kind of before and after my talk. But I focused mostly on different methodologies for analyzing financial markets, the pros and cons of each, how you can combine, different methods to maybe get a more nuanced understanding of the risk and returns available. Let's look at the bridge of some of these different financial analysis techniques that maybe you learned in school, or maybe you learned as a part of, going through a CFP program to get the designation. And now let's talk about, kind of how maybe they fit together, and you can get a more comprehensive understanding of what's happening in the financial market. So it seemed to go over well. No one got up and left. So that's in the middle of the presentation. So that's a good sign. 2 hours is a long time to be presenting and talking on your feet. I don't know how people that give these talks for a living can do it day after day. But yeah, it was a lot of fun. It was nice to give back. And like you said, it was nice to head back to the Monterey Bay, our old stomping grounds, and actually was able to meet up with my brothers and their families. And so, made it a little bit of a mini vacation while I was down there.
Oh, that's awesome. I love to hear that. Well, Mr. Armour, anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, I know we'll probably be talking about it again in the next podcast because we're still trying to get the word out. But just remind people, the golf tournament, I know we've been sending out a lot of emails. We've talked about it on the podcast. But we're a little bit slow in terms of getting signups this year. So hopefully if anyone's thinking about it, give the office a call. And if you're not getting the full foursome together, maybe we can pair you up with some other, kind of interesting, fun people and try and keep boosting up the participation.
If you want to subscribe to the podcast on whatever platform you're on, please hit that button now. And we are available now on YouTube. If you'd like to watch along, you'll be able to see the personal financial review scroll across your screen as Chase and I discuss all the topics here. And if you have yet to subscribe to the personal financial review, send Katie an email. It's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.